Good morning, everyone. Good morning and welcome to Albion Financial Group's Fall 2025 conference call. Thank you for joining us today. We really appreciate the thoughtful questions you've submitted in advance. They give us a great starting point for a meaningful conversation. Before we jump in, I'd like to introduce myself and our panel of experts who will be here to share their insights and answer your questions. I'm David Clark from Albion's operations team here, and I am your moderator for today's discussion. Today's panelists joining me on this call include John Bird, Chief Executive Officer and co-founder, Liz Bernhard, President and Senior Wealth Advisor, and Jason Ware, Chief Investment Officer and Chief Economist. As we wait for a few more attendees who are still joining us, I want to remind everyone that we encourage your active participation. Please submit your questions to us using the Q&A feature at the bottom of your Zoom interface. Our team will monitor submissions and do our best to address as many as possible during this session. We've structured this hour to serve you best by beginning with the foundational financial planning topics and our associated spectrum of services. These are the building blocks for strong financial health and essential context, whether you're planning, saving, spending, or otherwise preparing for major life events. Then, after we've covered the meat and potatoes of planning, we'll move into what I'm going to call the dessert of our discussion, which is the economy and markets. And that should round out and address all of the questions that have been submitted. Our goal is to provide you with a comprehensive view from planning to investing, so you walk away with actionable ideas regardless of where you are in your financial journey. So let's dive in. I'll now turn things over to President Liz Bernhard, who will lay a foundation for today's discussion by guiding us through some essential planning items. Liz, over to you.
Thank you, David, and hello, everyone. I guess I am meat and potatoes in terms of planning topics, and it's the end of the year. Can you believe it? I can't. Halloween's on Friday. I was just sharing what my kids are going to be for Halloween. Hopefully you all already have your costumes picked out, or you have an Amazon delivery on its way. As we always do at this time of year, we want to review some of the planning items that are subject to year-end deadlines. We did send out a letter already, but I am here to serve as your friendly reminder. So just running through some of the more common items that we work with clients on. First up is required minimum distributions, RMDs. If you know about these, you are likely 73 or older because that's who these apply to. So if you're turning 73 this year or you already are older than 73, you may need to take a required distribution from your retirement accounts, from your tax deferred accounts, and this needs to happen by the end of the year. If Albion is managing these accounts for you, we've likely already reached out to you about this required minimum distribution, or we will shortly. But please remember that if you have accounts outside of Albion that may be subject to required minimum distributions, other retirement accounts, especially if this is the first year that you're subject to RMDs, make sure you're taking those distributions. And if you have any questions, don't hesitate to talk to us. We're happy to help you and walk you through that. On a note of tax deferred accounts, retirement accounts, if you're contributing to a 401k or a 403b or some sort of tax deferred employer sponsored account, now is a great time to review the contributions that you've made so far this year and make sure you're on track to meet your funding goals for 2025, as all of those contributions need to be made by the end of the year. Giving is another thing that we'd like to talk to clients about and remind you about before the end of the year. That's charitable giving or otherwise. For charitable giving, your donations of either cash or appreciated stock need to occur before the end of the year. You can give directly to charitable organizations, and some people like to do that if they have an alma mater or maybe a religious institution that they want to give to. Or you can give to a donor advised fund, and these have certainly become more popular over the years. Just briefly, a donor advised fund is an account that acts as a charitable entity, and you can make contributions or donations to a donor advised fund. It sort of is a pool or a holding place for those dollars that you wish to then grant out or donate out of your donor advised fund to individual charitable organizations. They do have to be 501c3 organizations. So if you're someone who gives to a lot of different charities, donor advised funds can be a good option for you to keep in mind. So regardless if it's an individual charity or a donor advised fund, those contributions or donations need to happen by the end of the year. If you are somebody who is subject to required minimum distributions, as I just mentioned, and you don't need that money, that distribution to cover your living expenses, you may want to consider a qualified charitable donation, a QCD, because we're all about acronyms in financial planning. So a qualified charitable donation is when you take your required minimum distribution directly from your IRA or a portion of your distribution directly from your IRA and give it to a charity, a charitable organization. These cannot go to a donor advised fund. These have to go directly to a charity. This can be an efficient, a tax efficient way to do your charitable gifting if, again, you're in that required distribution territory, as the dollars that you donate or the distribution amount you donate does not count as taxable income to you. We are helping on the gifting, charitable gifting. We also are helping a lot of clients gift appreciated stock. We've had strong markets, and so there are unrealized gains in many client portfolios, and we are helping them gift appreciated stock, again, either directly to a charitable organization or to that donor advised fund. Gifting appreciated stock can be, again, more tax efficient than just giving cash. If you gift appreciated stock, that allows you to remove those unrealized gains from your portfolio, and you don't have to pay tax on them by selling them first to realize cash, or to raise cash, excuse me. Gifting appreciated stock can be a tax efficient way to do charitable gifting. If you're giving to smaller organizations, they may not be able to accept appreciated stock. However, if you use that donor advised fund that I mentioned, that's a way that you can do your appreciated stock and then turn around and gift out cash to those smaller charitable organizations. And charities and the donor advised fund, they don't pay tax when that appreciated stock is sold and those gains are realized. They're exempt. So it's a win-win. We're helping our clients gift not only to charities, but to family members or loved ones, utilizing their annual exclusion amount. Their annual gift exclusion amount. And as a reminder, for 2025, you can give up to $19,000 per person without using any of your gift or estate tax lifetime exclusion amount. And you also won't have to file a gift tax return. This can be a great way to move money out of your estate during your lifetime if estate tax is something that might be a concern to you, or if you just want to help out, family or loved ones from a financial standpoint. If you are married filing jointly, you each can give $19,000 to the same person, so a total gift of up to $38,000. And lastly, just reminding everyone, Albion is reviewing gains and losses in your portfolios. We do this throughout the year, and we will be doing this again before year end. And the reason why we do this is to try and minimize realized gains, which are taxable to you in the year that they occur. And as we say every year, if you have gains or losses outside of your Albion accounts, whether it is in other accounts or real estate or some other asset, please let us know just so that we can strategize with you in the context of your overall financial picture. And speaking of strategizing, we welcome the opportunity to strategize with you and your CPAs if you work with one. As year end approaches, I'm often meeting with clients and their CPAs to review what we know about their income and what we anticipate their income to be for the current year, and to discuss tax saving strategies that may be available to them, and strategies that we can implement before the end of the year. So if you think this would be helpful to you, please let us know. We welcome partnering with your other trusted advisors. So that would be the planning topic year-end reminders. While I have the mic, I also just want to talk a bit about the tax bill that was passed this year, just a few months ago. This is the One Big Beautiful Bill Act, also known as OB3. And there are a few provisions in this, mainly deductions that have are new or have increased, that I want to just highlight because I think it impacts many of our clients. So the first one to mention is the bonus senior deduction. So this is if you are over the age of 65, you are eligible for a bonus deduction up to $6,000 on top of the standard deduction that you've been normally taking in past years. There is a phase out for this based on income, so not everyone may get the full $6,000 deduction, but I think it will apply to several people, and so something to keep your eye out for as you're filing your taxes for 2025. And this is something that will exist through 2028, and then we don't know after that. Another provision in OB3 is the increase in the deduction that you can take for your state and local income taxes and your property taxes. So this is commonly known as the SALT deduction, and it has been capped at about $10,000, meaning if you paid more than $10,000 in your state and local income taxes and in property taxes, you can still only deduct $10,000 on your tax return. So this has now been increased to $40,000. So that cap has been raised to $40,000, allowing us to deduct more of what we're paying in income tax, state and local income tax, and property taxes. Again, there is an income phase out for this. The income levels are pretty high, so I think that many of us will be able to take advantage of this higher deduction amount, or this higher cap of $40,000. This is not just for seniors 65 plus. We can all take advantage of it. Just two more I want to mention. Starting next year in 2026, even if you itemize if you take the standard deduction on your taxes, you'll still be able to deduct some of what you donate to charities, which I think is great. So for those of us who take the standard deduction because that's most advantageous to us, and if me talking about taking the standard deduction versus itemizing sort of sounds like gibberish, we may want to meet with you and your CPA if you have one. So just keep that in mind as I'm running through these. We can certainly talk with you about this in more detail. But high level, if you take that standard deduction, you will be able to still take a deduction for charitable contributions that you make. It's up to $1,000 for people who file as single, and $2,000 for married filing jointly. And then lastly, for those who may be concerned about the estate and gift tax exemption amount, which I referenced earlier in the annual gifting, OB3 made the exemption amount permanent at $15 million per person, or $30 million for married couples filing jointly. and this will be indexed for inflation starting in 2027. We recognize that estate tax is not a concern for many people, but for those who it is, this permanence brings some closure to a saga that really sort of started back in 2010 when the Bush era tax cuts were repealed, and it took Congress a bit of time to pass new limits or legislation on estate tax and gift tax limits. So in 2010, if you happened to pass away that year or knew someone who did, there was no federal estate tax in 2010. And ever since then, it's been a bit of a question because all subsequent legislation has had, time limits on it. It would expire or sunset at a certain number of years in the future. So having this permanence of the current exemption amounts at 15 million and 30 million allows people to do some longer term estate planning that they weren't able to do prior. So that was a lot. In conclusion, if you have things that need to be done before the end of the year, let's make sure you're getting them done. And when you file your taxes in 2025, you may benefit from some of those additional deductions that came from the OB3 bill. And so now, as David said, on to dessert, and I will pass the mic back over to him so we can start talking about some of the economic and market questions that we've been hearing from our clients.
Thank you, Liz. Yes, so now we'll bring the questions out for everyone to answer. A lot of them are directed to Jason, but Liz and John, please chime in where you have the answer that you want to share, and perhaps if you have kind of market 101 or definitional contributions to help people who might not know the terms that we're going over, that could be helpful. So to begin, one of our biggest questions, and it's a big picture question, is Jason, what's your view on the likelihood of a U.S. recession?
Yeah, important question. And I've never had dessert at 10:17 a.m. in the morning. I imagine most of our listeners have not either. So that's a treat for us all as we go into Halloween. But look, it's a big picture question we get a lot. And the economy is a complex machine. It has a lot of moving parts. So to answer this question, I like to simplify that machine. The biggest driver of the U.S. economy is consumer spending. Consumer spending, though, isn't a monolith. Consumer spending makes up 65-70% of economic activity. So it's an important piece of the economy to pay attention to. And in the aggregate right now, it's steady and growing currently. Retail sales are running around 4 to 5% nominal year over year. Highly discretionary categories are up 3% year over year. Visa's latest quarterly report, which came out just yesterday, confirmed that spending across their vast payments network remains robust. And we have to remember, Visa touches so many elements of consumer spending in the economy, both the global economy and the US economy. So seeing what they have to say really is a nice window into how things are going. And so when you add it up on the aggregate, in short, things look really good right now. But drilling down, x-raying the consumer in greater detail is something we like to do. It gives us a better sense of how healthy spending really is and where it may go from here. And to us, one feature stands out. The top 10% of households by income and wealth right now account for about half of consumer spending. And think about what's happening in those households. Stock prices are at record levels, home values are high, savings remain ample, job and income prospects are solid. And so unsurprisingly, spending and consumption are too. The momentum continues. And unless or until those tailwinds change, and nothing we see suggests that they will anytime soon, we think the consumer and consumer spending remains in good shape. The old Wall Street adage still holds: if you get the consumer right, you get the economy right. And so we feel really good about the position of the consumer, which is the anchor of the economy. Outside of the consumer, capital spending in tech and AI infrastructure has been incredible. Roughly $400 billion in AI-related investment is being deployed this year alone. I mean, that's a huge number, $400 billion in AI infrastructure spending. And there's likely more coming next year in 26. Fiscal policy is likely to shift from a mild drag this year to a modest tailwind next year. And so when we add up the pluses and minuses, and we look at like Q2 GDP in the US grew at a 3.8% annualized rate. Q3, which we don't have yet, we should get this week, but because of the government shutdown, we won't. But Q3 likely ran at about the same pace, nearly 4% annualized. Some of that strength in Q2 and Q3 certainly reflects a reset in the trade balance after a heavy import quarter in Q1, where we saw orders surge ahead of tariffs. But even when we adjust for that, the U.S. economy is tracking at about 2% in terms of like its underlying real growth, maybe a little better than 2%. And so for now, we don't see the makings of recession. Things look pretty good. The economy's been resilient.
I always appreciate hearing from you, Jason, and what dessert you provide. When I think of this question, I really think of, for most of us on this call, yes, recession's an issue, but the bigger issue is, what is the risk to my portfolio today? I feel really good about where my portfolio is, but gosh, if we have a big market sell-off that's sustained, that'll hurt. So when I look at this question, I really want to put that lens on it. Volatility in the markets is a feature of the markets. You just can't get away from it. And so what do we try to do? We try to take a step back from that volatility and say, what's the impact? If we have a recession, meaning a slowing of growth, that likely leads to lower short-term interest rates, perhaps lower long rates. Those of you with fixed income allocations will see that those hold up extremely well in those environments. When we look at a slowdown in the economy, what's that going to do to corporate earnings? Well, it's going to slow them down for a little bit, but it won't kill them. Most companies will come out of a recession as in as good a position as they're in now, if they're already a strong position. If you're a company with strong moats, a great piece of the market, odds are you come out of a recession in a better position because some of your weaker competitors don't make it. So as we're building our equity portfolios and diversifying them across industries, across companies, we want to expose you to those companies that are likely going to actually come out of recessionary periods stronger, recognizing that recessions are real. They're part of the economic system. They should happen every 3 years or so. We're able to push them out more and more with monetary policy and some of the secular growth we've seen in the tech sector. But at least from where I sit, having managed portfolios for 40-something years, recessions don't scare me the way they used to, because we see them both as an opportunity and as a bit of a reset into the markets.
Okay, go ahead, Liz.
Sorry, David. I'm just going to chime in here and echo what John said, that yes, I think often when clients are asking about chance of recession and what is our view, really what they're asking is, how is this going to impact my portfolio, and what are we going to do if it goes down? And, oftentimes they can be taken aback when we say, we may not make any changes in the account if we see a recession, which is often accompanied by a market sell-off. And it's for many of the reasons that John just highlighted. We are doing the work now to put portfolios in a position to be able to weather a recession, which on average lasts about a year, same with a bear market. And in that, we're working with our clients to come up with that right asset allocation. So that's that combination of different types of investments, whether it's stocks, bonds, cash, the right combination of that meets their needs based on their risk tolerance, time horizon, needs from the portfolio. And remembering that asset allocation is about you, the client, you, the investor, not what's happening in the market. Money that we know we're going to need in the near term, we don't want to have that invested in the equity market. We don't want to expose that to market volatility if we know we're going to need it soon. Certainly diversification and owning good companies, as John mentioned, companies may, stocks may temporarily have prices go down. Companies may see their stock prices temporarily going to go down, but post-recession, they'll survive and thrive. Otherwise, we wouldn't own them in the first place. And then really, I think we have to, as Jason says, behave ourselves as investors, and we really work hard as advisors to help our clients remember what their goals are and to not let emotions drive our investment decisions, because we know that good and bad days in the market cluster around each other. And if we try to time the market or try to sidestep the bad days, we're often going to be also sidestepping some of the good days. And the data is pretty clear that if you miss just 10 of the best days in the market each year, your returns are hurt pretty significantly, can be up to 40% over time. So it's really that tenet of staying the course, having that right asset allocation, and then, as John said, owning good companies and being diversified.
It's amazing. If you miss just the best one day this year, you're underperforming by 10%. April 9th, the market bounced 9.5% after Trump backed off Liberation Day. So imagine if you had sold on the 8th, you missed the best day, big impact. So it's a good point.
Okay, thank you. So you've discussed how volatility and recessions are features of the market, but moving over to the policy side and the current situation with the government furloughs and this shutdown, this long shutdown that we are experiencing. Jason, or everyone, how is this shutdown different from past shutdowns, and how does how do we respond as investors to this kind of an activity?
Yeah, it's a great question. It's a topical question. I'll start by just talking about how it might affect the economy, and then maybe we can go into how it might be different this time. But I just want to start by saying, certainly those furloughed are feeling the impact. Forget the broader economy for a minute. There's real human element here that shouldn't be glossed over. Losing pay, facing job uncertainty, heightened anxiety, that's tough. And so we all hope this ends soon. As for the broader economy, we're now 29 days into the shutdown. It's the second longest on record. At this point, about 750,000 federal workers are furloughed or without regular pay. And according to CBO, that's about 400 million in lost, really deferred income pay per day as the shutdown continues. So if we think about like the basic math of what that means, so far, 29 days in, there's about a $12 billion hole in the economy. That hole represents lost spending, lost investment, lost output. Maybe that gets to 15 billion, maybe it gets to 20 billion before this is all over. We'll just have to see. But there's a lot of denominator blindness in the field of economics. And that $12 billion hole is on a $30 trillion US economy. So it's pretty small. It's about a 0.04% hit to GDP thus far. And even if this ran through, say, year end, that gets to maybe 0.1% of a growth drag on GDP. And so that's the first order math of shutdowns. But it's important to remember that usually all of that activity is recouped once paychecks resume. So it's not a true or a permanent loss, but rather it's a temporary deferment. And we're usually made whole eventually. But there are other more indirect drags from a prolonged shutdown that are worth mentioning. Firms that rely on government contracts can slow. There are delays in federal data releases that can unsettle markets and even lift bond yields. We get policy paralysis that can chip away at confidence and take back risk-taking a bit. And those second and third order effects can cause a little bit more of an impact on the economy as well. In fact, most economic models suggest that for every couple weeks the shutdown goes on, it trims GDP growth by about 0.1%. So 4 weeks in, we're at 0.2% if you take into account the second and third order effects. It's still manageable, but it's not nothing. We certainly recognize it's not nothing. Again, I think the good news is that most of this should be reversed once the government reopens, and we do think it's going to reopen at some point. And look, the final point I would make is the private sector going into the shutdown, as we described, the economy writ large, was strong enough to absorb the shock. And ultimately, it's the underlying private sector momentum, not Washington, that will shape where the economy goes from here. And so we'll continue to watch how things unfold, but we think we're in a pretty decent position going into this.
Okay, thank you. back onto the economy more broadly with and into the labor markets, with unemployment being low but job growth slowing down, should we be concerned?
I'll pick that one up. The short answer is I don't think so. Look, there have been some signs of softening job growth, to be sure. But as we've established, the economy remains resilient. Not only is the consumer doing okay, but when we zoom out and look at the broader US labor market, here's what we see. A strong overall workforce with a record number of people working. There's 160 million people gainfully employed in the US economy right now. 5 years ago, it was 140 million. 15 years ago, it was 130 million. So it's up and to the right. It's not straight and linear, but it's up and to the right. We have more people working, which means more income, which means more spending, which means a decent economy. And that's the basic math of how this works. Second, labor demand. Things like job openings and hiring plans are consistent with an expanding economy. We can look at like a JOLTS report. We can look at what Indeed is saying, ADP. There's a number of areas we can point to show that there's still a fair amount of labor demand out there, and that's a good sign. On the other side of the coin, layoffs are low. They've been low for several years, really, since we reopened after the pandemic. They're actually at generational lows. The last report we got on initial claims, which again have stopped because of the government shutdown and will resume at some point. But the last time we looked at initial claims, they were just over 200,000, which is very consistent with a healthy labor market. Wages are still growing faster than inflation. You don't give people pay hikes above inflation if there's a soft labor market, if things are rolling over. And then the final point I'd make on the state of the jobs market is there's a supply side piece to this, a reduction in immigration that has changed a bit the current break-even pace for the labor market. We think there's a lower equilibrium to sustain economic growth than there was maybe a year ago or 2 years ago. There's a tariffs and policy uncertainty piece to this. It's probably no coincidence that job ads stepped down around the time that tariff policy went up, or tariff uncertainty went up, I should say, trade war uncertainty. And then finally, there's a tech and AI piece. I think there's been at some level a pause by companies instead of hiring 3 new people, maybe you only hire 1 new person because you're exploring AI and what it can do in terms of increasing productivity. So when you add all of that up, yes, a slowdown in the jobs market. Is it concerning? No. Does it feel natural and part of the normalization process? Yes. Will we get through this okay? Yes.
And there's certainly a lot of press right now in the tech space about layoffs. I mean, Amazon just laid off 4,000 people, 4% of their workforce.
14 right now, going to 30, but yeah.
Yeah, 14 going to 30. So 4% of their workforce at 14. So we're seeing that, but it's 4% of the workforce, and Amazon, like every other entity out there, is trying to be more efficient with how they operate. We're seeing that in the tech space, and a piece of that is AI coming in, saying, gosh, we can do some of this work with AI. And it also is a bit of a relief valve because we've seen employment really tight in that tech space for several years. And that's indicative of that is what people right out of college or right out of a programming school are getting paid, which means, boy, there's a demand. So there is an equilibrium there. And if you had one of those jobs and you were laid off, just as with the government shutdown, it's painful. And there are other opportunities that continue to open up because the economy continues to be really vibrant.
Yep.
Okay, thank you. I'm going to turn to inflation now, and here's where we could use some definitions of terms. But I wonder, a question came in about headline in CPI versus core CPI inflation. So what are the differences there, and how do they shape our market outlook?
So I'll do a little definition education here before we hear from Jason and John on CPI. So as a reminder, CPI stands for Consumer Price Index, and the Consumer Price Index tracks the prices of a basket of goods and services that households typically buy. And the purpose is to track the change in the prices over time as a way to measure inflation. And so headline CPI is everything in that basket, all the goods and services. And core CPI, which really came about in the 1970s during when we saw a lot of volatility in oil prices, core CPI excludes food and energy from that basket of goods and services. And the reasoning for excluding that in core CPI is that they tend to have food and energy tend to have more volatile prices, and the volatility swings are sort of quickly reversed. So think about how weather or seasonality can impact food and energy prices. Now, it's fair to say that households, buying food and putting gas in your car can be important components of what households spend money on. So sometimes headline can feel more like real inflation to people or what they're experiencing. But that's the definition. Headlines, everything, core excludes food and energy prices.
So I'll jump in. Thanks, Liz. That's a great way to frame it. Good definitions there. As we think about how it shapes our market outlook, which I think was a piece of that question. So the difference between the two measures don't really matter much, especially as it relates to the outlook. These variances, first of all, are fairly minor. The latest monthly reading of CPI, which we just got last week, shows a difference of 0. They're both 3%. Over the past 2 years, since things have settled down and normalized post-pandemic, the difference between headline and core is about 0.2, maybe 0.3 annually. So it's not a massive difference. And so we prefer to look at inflation in the aggregate, which does take into account headline and core, but it also spans CPI and PCE. And PCE is the Personal Consumption Expenditures Index. It's the Fed's preferred gauge. It's our preferred gauge. It's a little more comprehensive. It makes adjusts for substitution effects and other things that we think are more economically accurate in terms of trying to assess inflation. But we also look at things like inflation expectations, both market-based and survey measures. And that's at the aggregate level. So we're paying attention to what's happening top line. And then we drill into the inflation baskets to look at the components of inflation, to see where the underlying pressures are coming from, to get a sense of inflation momentum. And so on the former, that aggregate level, last year, calendar year 25, inflation ran at about 3%. This year through September, inflation is running about 3%. Just under, to be precise. If you look at PCE, it's like 2.7. And this is all despite upward pressure from tariffs, right? There's been a lot of talk in the markets. Tariffs are going to reaccelerate inflation. We're going to have an inflation problem because of tariffs. So what does that tell us? It tells me that underlying inflation is actually slowing. Tariffs are showing up in some of the inflation data, not a lot, but enough to show up. But it's only on the good side of the ledger that we're seeing some tariff inflation, in particular durable goods, which is a much smaller category than things like services and housing within the inflation baskets. I mean, we're a services economy, so it makes sense that most of the inflation we experience comes from services. And to give you some context, last year at this time, super core services inflation, which is just, it sounds fancy, but it's just simply core services less housing inflation. Economists love to slice and dice things, as you might be kind of picking up on. That was running at 5% last year at this time. Right now, super core is running at 3%. Meanwhile, housing inflation itself is at the lowest level in 4 years. We just got a Case-Shiller report yesterday that showed 1.5% growth nationally. We think that these trends continue. And so when we put it all together, softer services and housing costs are more than offsetting tariffs on goods. And it's keeping overall inflation stable in that 2.5% to 3% zone. I mean, that said, we still think outside of recession, of course, because the recession brings down inflation further. We don't think there's a recession coming. We don't have a perfect crystal ball, but we think things still look pretty good. But recessions do bring down prices. So if we stay outside of recession, we think inflation continues to run modestly above the Fed's 2% target. We've called it a 2% plus world now versus the 2% minus world we had in the 2010s. But that pace of inflation, 2.5%, 3% for the balance of this decade, seems likely. And we don't think that's problematic for the economy or the financial market. So we're in a pretty benign spot as it pertains to inflation, in our view.
Yeah, a little context on that as well is they started recording, the CPI started in 1914. The average inflation rate 1914 through 2025 has been 3.29%.
Yep.
So we're right in the range. Of course, the record low was negative 15.8% in 1921 with a record high of 23.7 in 1920. So we're right in the range of what this country has done for over 100 years. Certainly lower inflation is better. There are two lenses we need to look at this through. One is as a consumer, and certainly if you're a consumer and prices are going up, life gets more expensive. The other is as an investor. And as an investor, our objective is, can we have our portfolios outpace inflation so your purchasing power goes up over time, even in an inflationary environment? And that certainly is why we have an equity exposure, or a piece of why we have an equity exposure, in that those companies tend to be able to raise their earnings at a rate greater than the inflation rate over time.
Okay, so you've talked about inflation. I'm going to stay in the vein for a little bit. You've mentioned the Fed target of 2%, that we're above that still, and there's still some tariff pressure. But how are we positioning our portfolios for a possible rate cut that might happen? It sounds like the Federal Reserve is meeting soon.
Today, yesterday, and today, yeah.
And then while we're still guarding against inflation risk, so how are we positioning portfolios for those?
I'll jump in on the equity side. It's pretty simple, and as John just kind of touched on, like we don't quote unquote position for rate cuts with the equity portfolio. We don't position for like, is inflation going to drift up or drift down? Instead, we diversify and we own great companies. We own quality investments that can stand the test of time, that can do well in slow inflation environments, in higher inflation environments, with Fed funds rates at 5% or 1%. We want to own businesses that are much less cyclical and much more secular in growth. And that helps kind of cut through and reduces the need to have to forecast this stuff, which nobody can do consistently. And so that's the message on the stock side. Diversify, own great companies, let them do what they're going to do. On the inflation piece, more precisely, equities, and John touched on this, equities are some of the, if not the best asset class to protect against inflation out there. And some equities are better than others. We consider businesses with pricing power and above market growth rates to be superior against the specter of inflation. Revenues and earnings are nominal, meaning that they go up with inflation, because companies, if you're a good company, you can usually push that onto the consumer. And again, as a consumer, as someone who's in the stores and out there shopping and ordering on Amazon, like, I don't love that. But as an investor, that's what you want to see, because it protects and preserves profits and allows the company to grow through inflation. So on the equity side, we're not trying to guess where the puck is going on inflation short run, nor are we building the portfolio for rate cuts. We just want to own good businesses.
Right. And on the fixed income side, we tend to be short to intermediate term. So if we have an inflationary environment, bonds come due. We get the proceeds and we can reinvest them at the higher rate. If rates go down, well, the longer bonds, the more intermediate term bonds in the portfolio will benefit from that, because we've locked in that higher rate. So we're trying to hedge in the fixed income piece, regardless of the direction of interest rates and inflation.
And I would just add, in terms of what we're seeing right now with possible additional rate cuts, and I think we're going to hear this afternoon from the Fed, if I'm not mistaken, on whether we'll have another rate cut. The Fed, when it cuts rates, it's cutting the Fed funds rate, which impacts very, 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 very short-term interest rate instruments. And so how does this impact portfolios directly? Oftentimes it's through money markets or treasury bills, right? So if you're somebody who has a lot of cash in a money market right now, and money market rates have been high, relatively speaking, and they're still hovering around 4% in terms of at least, the money markets that we're seeing at Schwab and Fidelity. Money markets are going to probably feel the effect or reflect the effect of a Fed rate cut first, or right away. So you'll see that rate or that interest that you're earning on your money market tick down a bit. Treasury bills, so these are short-term government bonds, essentially, where we're talking about months or maybe a year or two. That's another place because these are short-term debt instruments where you're going to see those Fed fund rates really affect what we're able to earn on new issues of T-bills. So if you're somebody who's got a lot of cash parked in your portfolio right now in money market, I think it's worth asking or having the conversation about, why do you have that there? And is liquidity really important to you? Do you need that to be liquid in money market, or are you just taking advantage of the rates that we can earn on our cash right now and enjoying the stability that having that cash position adds to your portfolio? And if it's the latter, it might be worth considering a bond allocation in where we can lock in the rates for a fixed period of time. Now, I know not everybody loves bonds, but it's still something to consider if that stability is something that's appealing to you. And again, where we can lock in that rate so we're not subject to, the interest we earn ticking down as the Fed cuts, if and when they cut.
Okay, thank you. I am going to pull in some questions that have come in from the audience, if I may. We have a question about Albion's trading technology here. Does Albion use AI for trades?
So I guess there's two ways to think about that. There's, do we use AI in our research process? And then there's, do we use an AI program to execute trades? And on the first piece, yes, we do use AI in the research process. AI is a powerful tool. It's become more powerful. I signed up for ChatGPT literally in November of 2022, and it was terrible. And now it's really robust, and there are no shortage of tools, research tools that we've used for years at Albion that are now incorporating AI into those tools. And so it does allow us more reach, more efficiency. We can do more in less time on the research side. So it's been an incredible asset for us to be able to augment and improve the quality of our research. So yes, on that piece. We're in earnings season right now, corporate earnings season, and what used to take literally weeks to go through all of these company earnings reports that comes in, we've been able to compress that down by a significant amount of time and actually get more out of earnings. So it's been a fabulous tool. As it relates to actually executing trades, the answer there is no. We have a software stack here at Albion, a portfolio management software stack. And on my team, the investment team, we have a group of awesome, wonderful traders that do an incredible job of looking at everybody's accounts on an individual basis and making sure that those accounts are invested for you and to reach your goals and to satisfy your objectives and to make sure that we're checking all the boxes that you need for your portfolio. And so what we don't want to do is introduce an AI tool that's going to essentially just democratize everything and make everything vanilla. That's not who Albion is. It's not who we're ever going to be. And so we want humans in the mix. We want to be able to look at each individual portfolio and make deliberate and intentional decisions. So no on AI as a trading tool. We still have a fantastic group of traders here, and that's not going to change.
Okay, thank you.
Yeah, Jason, I'm really glad you hit on that, because AI is an amazing tool. We are adopting it across the company in a variety of ways, but ultimately we are a human and relationship business, and AI does not know the particulars of each of you out there listening right now.
Yep.
And we endeavor to.
Yep.
We really endeavor to make sure we're reflecting that properly in how we manage your portfolios.
Okay, thank you. And now another question that just came in. Can you talk, please, about changes to the Affordable Care Act and impacts to those who rely on it for healthcare insurance coverage?
Boy, I don't know what we have to add here. We are all waiting to see how this government shutdown plays out, which has a lot to do with the Affordable Care Act. The OB3 has an impact on the Affordable Care Act. The shutdown is largely about health insurance and the cost of health insurance. What we can say is it will become more expensive for people who have benefited from the Affordable Care Act than it was before. And I'm not sure where else to go with that. Any other insights from this panel?
No, I think it's a big TBD, unfortunately, because you're right. That's at the heart of the standoff. So we'll see what happens.
I'll just acknowledge that open enrollment is coming up, and there's a lot of question of how will the plans be priced, and what we'll know, and will we have to push off open enrollment, or will they have to, the government have to push off open enrollment? And I wish I had the answers to those questions, but I just acknowledge they're out there, and we recognize that.
Okay, thank you. The next question that was submitted during the call here, another recent submission was, can you talk about the 2016 401k contribution changes? I think maybe that means 2025 401k contribution changes.
Sure. I will just highlight where we are right now for 2025. So you can contribute up to $23,500 to your 401k or your 403b as an employee. If you're over the age of 50, you can do a catch-up contribution of $7,500 to your 401k. And then with Secure 2.0, the Secure Act 2.0, there's the super catch-up limit, which if your ages 60 through 63 in 2025, you can do a super catch-up of $11,250 if your employer plan allows for these super catch-up contributions. What's going to start happening next year in 2026 is that for certain high income earners or participants in eligible retirement plans, those catch-up contributions are going to have to be made as Roth or after-tax contributions rather than pre-tax. So you won't get that additional tax deduction or income offset if you're a high earner and making those catch-up contributions. But that does not start until 2026, that Roth component.
Okay, thank you. So here's another question that was submitted before we started the call. This one's drilling into some specifics for you, Jason, here. Given that market performance has been quite concentrated in 7 large companies, how is Albion managing exposure to big swings in this group and or if one of them falters?
Yeah, it's an important question. And the short answer is diversification. We don't put all our eggs into one basket. We're also very intentional on how we size positions. No matter how bullish I am on a stock, there's always a little risk managers standing on my right shoulder here, reminding me to size accordingly. Enough to benefit from our research, but not too much, because we also must invest with humility. A lot of you have heard me say that in the past. We don't have all the answers, and we've been wrong, and we will be wrong again. And so we want to make sure that we're careful about how we size stocks, and that includes the Mag 7, as they're called, Magnificent 7, the mega cap tech stocks, because we do own 6 of the 7. I call them the Splendid 6. I really hope that's going to catch on. We'll see. We also do deep due diligence. I want to make sure that I hit on this because it's really important. Both initially on the companies that we own on your behalf, but also in ongoing fashion across all the investments that we own. Every day we are watching them. We are making active decisions. And if you're doing it right, that activity is mostly in neuron form, as we don't previously buy and sell our positions. It's thinking about them. It's investigating what's going on. It's making judgment calls. By design, we own great companies, which means the hurdle rate to sell is high. We do make changes at times when conditions warrant. For example, this summer, after 12 years of never selling a share of Google, we finally trimmed some from our strategy. We also trimmed Oracle into a big rally this year. These are fundamentally rooted decisions, and we will continue to monitor portfolios and do the best job we can, making the best decisions possible with the available information while drawing on our experience. And that's just what we bring to bear every day. Specifically as it pertains to wild swings in the Mag 7 or the mega cap tech group, all I can say here, and I recognize that this is not a very satisfying answer, and I think John or Liz and John probably both mentioned this earlier, volatility is just part of the experience of being an equity investor. It's what we sign up for when we buy stocks. Dips, pullbacks, corrections, they're just part of the process along that magical journey of compounding returns. I want to give you an example. So Amazon, a company we own, went public in 1997. And in the 28 years that it's been a public company, it's experienced a peak to trough drawdown of 20% or more. So a bear market, by the definition of a bear market, which is 20% or more of a drop, in 24 of the 28 years that it's been a public company. That's 85% of the time it experiences a 20% or more drawdown. Okay. I think in 4 of those years, it was 50% or more. That's huge. There's a lot of volatility in Amazon. And yet, despite those wild swings, Amazon, and get this, Amazon has compounded at an average rate over 28 years at 32% a year. That's its CAGR, 32%. For those of you math inclined, that's 250,000% return since its IPO. Why? Because revenues and profits at the company have compounded at 45% over the same period. So Ben Graham once said, investing is most intelligent when it's most businesslike. Stock price movements over the short run are usually noise. It's business fundamentals that matter most. And so as we think about Amazon and we think about the Mag 7, Splendid 6, everyone's going to be saying Splendid 6. I'm going to make this happen. As we think about them as a group, a super simple way that I like to think about it is I think through like what we own and why we own it. If you were to say to me, like, given all that's going on right now in AI with agentics and cloud and at the data layer, are the Splendid 6 going to be way bigger in 2 to 3 years or way smaller? If you just, I know that's kind of reductive, but if you were just to break it down to that question, I'll take way bigger. I think there's a very reasonable chance that happens. There's going to be volatility along the way. And so we want to retain some exposure to that incredible secular growth that those AI companies and these Splendid 6, I got to catch myself, that opportunity they represent for the portfolio in the years to come still looks really good to us. And so there will be swings, yes, but volatility is a feature, not a bug, and they're great companies. So we'll continue to own them and monitor them.
Okay, thank you.
Sure.
We are doing really well on time, everyone. So I want to ask one more question, our final question before then anyone has any closing remarks. But the question is, this came in from a client who reads from our quarterly letters. Says, I've heard reset used in the financial media, a specific term I don't hear in your letters. What does that term mean from your perspective?
Interesting. Good question. So reset is not a technical term. I'll start with that. It's not one that we're missing, I think. It's probably more used in just like financial media to describe something that the author is trying to convey. You know, there are big picture like things that define markets at any moment. Secular stagnation, reflation, whatever. All along the way, there are usually these periods where you can define what's happening in the market by a phrase. We haven't used reset, I guess, because I don't think that's, at least from my perch, that is not something that is truly defining what's happening in the market right now. But I will say that perhaps one of the ways that we've been talking about a similar idea is we've talked a lot about normalization over the past 2 to 3 years post-pandemic. We had a really weird start to the decade, came into 2020 with a decent economy and record high stock prices. Interest rates were, Powell was cutting, but we had just gotten through Janet Yellen raising interest rates in the middle of the decade. And then boom, we get hit by a 100-year pandemic. and we go back to ZIRP, which is zero interest rate policy. We held there for a while, flooded the system with a ton of fiscal stimulus, $5-6 trillion, and shut down the economy for a few weeks, reopened. And then there was this hangover effect post-pandemic where everything was weird for a while. Supply chains were snarled and inflation got to 9%. And yet the equity market rebounded quickly. It was the shortest bear market in a generation, but rates stayed low. So we had a lot of weird things going on. And so in the echo of that, we identified, and I think it was in 2023, we started talking about in our quarterly letters on these conference calls, this idea of normalization and essentially a reset back to a normal economic environment post-pandemic. And so we've been seeing a reset, if you will, for a couple of years now, a reset in the labor market, a reset on inflation, a reset on valuations, a reset on interest rates. That doesn't mean there isn't an uncertain path ahead. We certainly are dealing with uncertainty right now. But reset in our world means things have gotten back to normal, and we need to adjust the portfolio and invest the portfolio for what we see over the next 1, 3, 5, and 10 years under a normalized economy, as opposed to kind of what we've all experienced over the last 5 years, with the first 2.5 of those 5 years being really weird. And so, yes, a reset in that context has happened. We've been watching it. We've been talking about it. And I think the good news is that whether it's a reset at the macro in terms of economics, or whether it's a reset in markets with regards to technology and AI, whether we use the term or not, rest assured, we are scanning the landscape and we are paying attention to everything that we possibly can that's going on. And that is reflected in the composition of the portfolios that we manage for you. Maybe I'll let John and Liz chime in if there's anything you guys can think of on this question.
Jason, I think you did a good job there of describing how reset tends to be used in the popular press, of this change over time, either back to something or towards something. And I think it diminishes the complexity of all that's actually happening. So it's a convenient word, but I'm not really sure it gets the point across.
Okay, well, thank you for that thorough answer, and thank you to all of the clients who have joined us for this call today and who submitted these questions and in advance and during the call. We really appreciate your participation. And if any of these topics or if any of this discussion has brought questions to your mind that about your own personal situation or your family's situation, please reach out to your senior wealth advisor so that we can discuss that matter with you. And with that, we hope that you enjoy the upcoming season of holidays and the rest of your day.